Ready to roll again? We're going to be looking at P Trading Company for the next hour and most of the rest of the day. If you turn to the case that you received in the mail, and there's a case in the binder too. If you didn't bring the one you received in advance, use the one in the binder. But the best one to use is the one that you received in the mail, because the page numbers correspond to the page numbers that I'm going to be using. They renumbered them when they put the binder together. Okay? So if you can get your case out, it's the one with the curled edges that fell in the bathtub last night as you fell asleep reading the case. Okay, and turn to page 5 of the case. That's the balance sheet. We're going to be looking at the balance sheet of P Trading Company, and how I've approached this section is, since I didn't prepare the balance sheet, I took it from scratch and said, okay, how would I go about analyzing the financial statements of P Trading Company? And I went to work, and what I ended up with was a series of ratios, and so then this section is substantially based on ratio analysis. Now, ratio analysis typically is best when you have a number of years to compare. It's difficult using just 2 years, but we're going to use it here because 2 years is all we have, and it does provide some indications. So I'm going to go through the financial statements of P Trading Company and tell you how I analyze these financial statements. First of all, we're going to look at individual balance sheet components, and then we're going to take an overall overview of the balance sheet, and then we're going to look at the individual income statement components, and then do an overall of the income statements, and then we'll come up with some summary conclusions. Looking down the balance sheet, the first item we see under current assets is cash. Cash really needs no explanation. There's no substantial increase relative to the rest of the numbers on the balance sheet in cash, so we'll just pass over it. Then we come to accounts receivable. Accounts receivable, if you look at note 2, which is on page 8, note 2, it says that receivables and inventory have been pledged as security for the bank loan. So that's been assigned to the bank as well as inventory. Now we see the number 123,000 compared to 69,000 the previous year. There's been a very, very substantial increase in accounts receivable. So what I did is I calculated the average number of days in accounts receivable. Now, to follow me, you should be on page 41 of your binder, and I think that'll be the best way. If you have the statements, if you have the balance sheet open on one side and the binder, my binder notes on the other side, then we can go through it together. I've designed the notes in point form so they're easy to go through it together as we proceed. So at the bottom of page 41, I've calculated the average number of days in accounts receivable. So we see that for 1983, it's 60.5, and for 82, it's 41.7. So what that says is that on average, there's 60.5 days of sales, of this company's sales, in its accounts, invested in its accounts receivable. Or, on average, they're 60 days old. Now, as Lou discussed before, you have to be very careful in using the averages, but this is our first step in trying to get some sort of trend. So we see that the age, or the indication is that the aging is 50% older than it was in 1982. So we would say that doesn't seem to be a positive trend if the receivables are getting older. And we would ask a lot of questions. What we're going to do in this session is we're going to ask a lot of questions and point you to the things that are not in the financial statements, but that we would like to know. So we are going to come to a conclusion based on the financial statements, but we're also going to end up with a list of questions, a list of concerns, and a list of things, of additional information that we'd like to know. So our concern with accounts receivable is why do they seem to be getting older? Is it poorer quality? that would normally be the case than in the previous years. Has management been less aggressive in collections? Have they been selling to poorer credit risks to increase sales? If you look at the sales number, and we'll get into this a little later, sales have increased 22%. So has part of that increase being selling to poorer quality accounts, and therefore it's being stretched out. Now, a thing you have to be careful with the ratios, because they reflect a relationship at the end of the period, in this case December 31st, 1983, is that something that has happened in the last month, 2 months, or even the last day over the year end can distort the ratios. So if there was a large sale that happened in the last month, 2 months, maybe even 3 months, and that sale was a credit sale and is included in accounts receivable, then it could distort the margins, and that may be the reason for the going from 40 to 60 days. Also a payment pattern change in major accounts. Maybe the receivables were high on December 31st, but on January 3rd, a $60,000 payment came in, and the ratio really is better. But these are all questions that in reading the financial statements you'd want to ask, and these are concerns that you'd raise. Looking down the next line from accounts receivable, we see marketable securities at cost. Looking in the 83 column, there was 20,000 at December 31st, 83, and 20,000 at December 31st, 1982. The market value to the left in the caption is 28,000. Now, the marketable securities, it would seem for this type of operation, have been there over the two years. Would seem to be, although we don't know for sure, it would seem to be that they were the same securities, and therefore those securities would not be needed in the business operation for this company. Those securities then are what we call redundant assets, and Bill will be getting into this more this afternoon on how a redundant asset needs to be factored into the business valuation. But we can see that the securities are worth $28,000. The cost is $20,000, so there's an $8,000 unrealized gain there. Theoretically, when you're analyzing a business, the redundant assets should be removed from the analysis, so you just confine your analysis to the business itself. Okay, moving on down, we look at inventory. It's cross-referenced to Note 2. We already said that it was given as security on the bank loan. Inventory is $246 this year. Last year it was $212. Seems to have gone up significantly. My next calculation was an inventory turnover ratio. Looking down at the bottom of page 42, you can see how we've calculated that. We take the cost of goods sold and divide it by the inventory. Now we come out with 2.0 for 83 and 1.9 for 82. So that appears fairly consistent. Now, what the ratio says is that our inventory is turning over about 2 times per year. Or to take it another way, we would have 6 months sales in inventory on average. Now, it would seem that the trend, although it's gone up 1/10 of a point, that the trend would be very positive if their sales have increased by 22% and they've managed to hold the inventory online. But again, you need to be careful of what's happening around the year end. Has there been a large shipment before the year end, a few days after the year end? And those are types of questions you'd want. Or is that their normal inventory for this sales volume? Now, the cost of goods sold number should only be cost of goods sold of items which are inventoried. So if you're running a business, someone comes to you and you place an order for that customer directly with the supplier, and that comes in and then is forwarded immediately on to your customer, you haven't inventoried it, so it shouldn't be included in cost of goods sold. This hit home to me very much yesterday. I was with a new client, and we'd calculated his inventory turnover ratio, and it came out to 2, and I thought that for that business it was very low. So we started talking about it, and then we found that in cost of goods sold, his installation cost is in there, and he uses an outside installation, which he passes the cost on directly to his customers. So he doesn't make any profit at all on the installation. So that's an item that was in his cost of goods sold, which is not an item which is inventory. Furthermore, he sells a lot to contractors, and those orders tend to be large orders, and they're direct orders. So he places the order directly to the factory, material comes in, and he forwards it on to the contractor. So that also has to be backed out because it's not normally included in inventory. And when we did that, the ratio turnover dropped to 0.75, which means roughly he's got 16, 17, 18 months of inventory, of sales in his inventory, which is, of course, very, very high. So we went out to look at the inventory, and there's no one in this room that would have a difficult time figuring out why the inventory has sat there for 18 months. So those are the types of things that the ratios can lead you in. If you never calculated the ratio and you never asked the question in the first place, then asking the questions can lead you directly into something which isn't in the financial statements. And a lot of times most times you're more concerned about what's not on the financial statements and what the financial statements don't show than what is in them and what they do show. So although you only have 2 years to do the ratio analysis, it can give you a trend and it can give you an inside look. Okay, moving down into the next category is prepaids. Prepaids are small, so we're not going to really, normally they will be small. If they're large, then you should ask some questions as to what they are. But 9 times out of 10, they'll be very small and you just pass on them. Due from S Company is small. Now we see investment in S Company Limited at cost, Note 5, $100,000. So we flip to Note 5 because it's new this year. Note 5 is on page 8. And we see that the company has acquired all of the shares of S Company, and that this happened on December 30th, 1983, and the price was $100,000. Okay, so then we say, well, what's this S Company? And we look to the balance sheet of S Company. If you don't have one, you ask for one. And that's on page 9. So we flip to page 9, and we see the balance sheet of S Company. Now, we're not going to do an analysis on the balance sheet of S Company, but we can see over to the far right-hand corner, retained earnings of $60,000, land of $10,000, and the building is the other significant fixed asset in at $50,000. So we then start asking more questions like, what's the land worth? And we find in other sections of the case that it's worth $20,000. And what's the building worth? And we find that it's actually worth $60,000. And the retained earnings is $60,000. Now that ties directly back into the calculation that Lou gave you on consolidated financial statements this morning. Because we've acquired S Limited on December 30th, 1983, there's no period of earnings during which we owned S Limited which go on P's consolidated income statement. So P's consolidated income statement and P's unconsolidated income statement will be exactly the same because there's no portion of earnings. For fiscal 84, there'll be a full year of earnings on P's consolidated. Now we flip over, and we're also provided with, to page 11, we're provided with P's consolidated balance sheet. And if you look down the left-hand side, 3/4 of the way down, you'll see a number 20,000 under goodwill, other assets. And that's the goodwill that Lou was referring to this morning. And that's how it shows up on the consolidated statements. If you look up a bit under fixed assets, building, you'll see it's now recorded at $60,000, which is the fair value of the building. This is the fair value increment. And the land is recorded at $28,000, so its fair value was $28,000. Okay? Now, if we look at the statement of changes in financial position of P Trading, now that's page 7. As Lou said this morning, the statement of changes in financial position highlights the significant financing and investing activities of the corporation. So if we look halfway down the page, we see that working capital was utilized for the investment in S Company of $100,000. Where did the money come from? If you look up where, under the caption, working capital was provided by, you'll see issue of preference shares for $90,000. So out of the $100,000, P Limited raised $90,000 through the issuance of preference shares. And we'll see that in a few minutes as we go through P's balance sheet. So that's the investment in S Company. If you flip back to page 5, we'll continue on down the balance sheet. The next item is fixed assets at cost, and that's important. So these fixed assets have been recorded at historical cost. Reference to note 3, if you flip to page 8, says that the fixed assets have been pledged as security to the Federal Business Development Bank. So we've got our fixed assets at cost. We look at delivery equipment. Delivery equipment has gone from $40,000 last year to $58,000 this year, $18,000. First thing that comes to your mind is that they bought a truck. Office equipment, 20 to 15, so 5,000 addition, no big deal. Leaseholds have remained constant. Now we ask, if we flip to page 8 again, note 1B in the financial statement tells us that these financial statements are being depreciated. Delivery equipment at 25%, and office equipment 12.5% straight line per year. So we wonder, since these fixed assets are recorded at cost, we wonder what the fair value is worth. So that would be a question. In the case, we're told that the fair value of those fixed assets are worth $58,000. So with that, we have another $34,000 that is not included in our accounting retained earnings, but of which the value is in the company, in these assets. Now, if we turn back to page 7 again, the statement of changes in financial position, since the depreciation was deducted from the income statement and it's not a cash outflow or a working capital outflow, then it gets added back on the statement of changes in financial position. And we can see depreciation and amortization there of $24,000. And then we see purchase of fixed assets, the $23,000. That's the $18,000 truck and the $5,000 office equipment. Now we turn back to page 5 to continue our analysis of the balance sheet. Our next item we're going to look at is land. Land was $8,000 last year, $8,000 this year, so we didn't acquire or sell the land. But it's interesting to note that under the fixed assets, there's no building. So that tells us that this land is vacant land. So the question there is the land a redundant asset? Is it used in the business at all? Chances are that it's not, but there's also the possibility that it could be a parking lot or storage area, outside storage area, or something like that. So we want to know whether or not the land's redundant asset, and furthermore, we'd want to know what the fair value of the land is. Now, the fair value of the land, we're told in other information with the case, is $40,000. So we have another $32,000, which is not in the retained earnings of the company. Okay, moving on down on the balance sheet, we have a distributorship. We have a distributorship fee. And the distributorship fee is not referenced to Note 1, but if you look in Note 1, you'll see in D, Note 1, page 8, that this relates to the 40,000 Orient hand tools. Of more concern to us is what is the distributor fee worth if you were to sell it, and is it transferable to a new purchaser? Sometimes these agreements have very specific restrictions on who they're transferable to. And of course, the transferability is an important factor in determining the value. So that pretty well finishes up the balance sheet. The rest of the items there are minor items, so we don't worry about those. Now we turn over to the right-hand side of the balance sheet, page 5 again. The bank loan is referenced to Note 2. We've looked at that 2 or 3 times. Just says that securities and inventory have been pledged as security for that loan. It's gone from 115 to 150, which is no great big deal, given the increase in receivables and inventory, and the same with accounts payables and accrued liabilities immediately below it has gone from 81 to 115. Income taxes is small, no big deal there. The current portion of the long-term debt. The current portion of the long-term debt is the amount of principal that is expected to be repaid within the next 12 months. Now that debt, Note 3, as we've looked at a couple of times before, that debt is the FBDB debt, and the $10,000 is the principal portion that is going to be repaid within the next 12 months, and that's why it's classified as current liabilities. Now we flip down, so long-term debt, it was $5,000. It's $5,000 this year. Last year it was $15,000, but that's because $10,000 principal is going to be repaid, so it's now flipped up. We look at deferred income taxes, 1,789, and that's a small number, an insignificant number, and also doesn't warrant a lot of time, but that's important because that tells us that there are no significant timing differences about to reverse on us that would create a future tax liability, an unbooked tax liability. So although it's small, it's critical. It tells us that there's really no significant timing differences around anywhere in the system. Now we flip down into shareholders' equity, and we see 90,000, 13% cumulative preference shares. So we'd ask, that's new this year, so we'd ask the question, who owns these preference shares? Are they the existing owners, or are they someone new? The supplementary information in the case tell us that it's Mr. A's relatively affluent parents that have bought the preference shares. However, the relatively affluent parents seem to be getting a very good return on their money as they receive 13% cumulative dividends. So we may want to ask some questions there. Why was the rate set at 13%? Perhaps the purchase of S Company was considered quite risky, thereby requiring the parents to demand or require such a high rate on the shares. So Note 4 just explains that the shares were issued for 90,000. Now we look at retained earnings, 195 this year, last year 150. So that seems to be positive. It seems to be a fairly good increase, considering that all the other numbers around the circle have expanded. So we've now looked at the individual components of the balance sheet. We're going to now look at the balance sheet as a whole. And if you're following through with me, we're now on page 45. And we're going to look at some ratios. The working capital position of the company is its current assets minus its current liabilities. Current assets are assets which are expected to be consumed within the normal business cycle within the next year, as current liabilities are liabilities which are expected to be paid, existing at the year-end date, which are expected to be paid within the next fiscal year. So we're really looking at and when we look at working capital, at the liquidity of the company, at the ability of the company to meet its current liabilities out of its current assets. So our current ratio is simply current assets divided by current liabilities. We find that it's 1.43 this year and 1.47 last year. So it's down a bit, which means that the company, you would think that the company is not in such a good liquidity position as it was last year. However, we've adjusted here for the marketable securities, the redundant asset, and it comes down to 1.36 divided by 1.37. So it's comparable, and it doesn't look like they've lost much ground once you take out the securities. We look at a quick ratio. So if the company in pinch had to come up and meet all of its liabilities very quickly, what could it liquidate quickly to meet these liabilities? Cash, receivables, and the marketable securities. So we take the total of those, and divide it by the current liabilities to come up with a 0.55 as compared to a 0.45. So the company in a hurry is more liquid this year than it was last year, but not really a lot more. That's also called the asset or liquidity ratio. The ratio is all the same. It's the same ratio. It just goes under 3 different names. For a business like this, you'd normally expect a current ratio of 1.5 to 2 and a quick ratio of 0.75 to 1. Now these numbers are below that, and in this case there's no great alarm, although I wouldn't like to see them go too much below this, because they do not have much long-term debt. On the balance sheet, page 5 there, you only see $5,000 of long-term debt, where there's significant non-current assets, significant fixed assets, which have a value greater than what's recorded in the financial statement. So there's no great alarm, but you wouldn't want to see it go much less than that, because the working capital circle, as we call it, will get too tight. We look at the debt equity position in my notes at the bottom of page 45, where we take the total debts and compare them to the equity. Now in this analysis, I've done it 2 ways. Since the preference shares, the 90,000 preference shares were issued on December 30th at the end of the year, then I've backed them out from normal, and those funds were used for the long-term investment in S, then I've backed it out from the normal equity. So we see the debt equity ratio is comparable, and that's also normal. Anything less than 2 in this type of business we normally consider strong. Now in doing that analysis, you also would normally and theoretically, and we haven't done it here because it would be too complicated, we just want to give you the main concepts, adjust for differences in book value and fair value. So your equity really is your fair value equity. So all of those things like the land and marketable securities where we have in the building, where we have different increases in values, would also serve to pump up the equity. Now we flip to the next page, page 6, and we're going to look at detailed components on the income statement. The first thing we'll look at is sales. Last year it was $613. It's $748 this year. So as I said previously, we've got a 22% increase in sales, which sounds very good. But we look at the 22%, and if we said, well, a portion of that can be attributed to normal inflation, and we're not given what the normal inflation is for this business. Normal price inflation is for this business. So we'll just assume that it's 8%. If you take 8 off the 22, you're looking at a 14% real growth. So a 14% real growth for a company like this could be considered to be a substantial, a very high level of real growth. So the company is experiencing rapid growth and has kept its handle on inventory, so you've got some positive interrelationships there. We go down to our selling expenses. We see the advertising has doubled, and that is only $6,000. It's not really a material number, except that you wonder if the 22% or the 14% real growth sales number has anything to do with them doubling the advertising. And maybe they could get more leverage out of their advertising. Maybe their advertising should be $24,000 to realize further jumps in sales. So that would be a question. What's the potential there? It's very subjective to ask that question, but again, you'd want to look at that. We look down at our selling expenses, salaries, and commissions have gone from $58,900 to $40,000, which is a 48% increase. And what you have to be careful when you see some of those numbers jumping so rapidly and the sales going around so rapidly is that have they increased these expenses in the latter part of the year? So if they have, and their overhead type of expenses, and they've jumped their expenses 48% year to year, but they've increased them substantially in the latter part of the year, then you could be looking at a number there of $75,000 for a full year, which you wouldn't see till 84. So you have to be asking questions like that as well to get a feel for what they're doing. Furthermore, they may have taken on some salesmen in the last 2 or 3 months, and has taken 2 or 3 months to get the salesman in harness, so they're not really getting anything from that salesman, and those sales will pick up in fiscal 84 as well. So those are types of questions you need to be probing when you see those numbers jumping around. The other numbers we're not too concerned about. They seem relatively comparable. We go down to general and administrative expenses, and rent. Rent is very, very comparable, but we wonder whether that is a fair market value rent for the premises used, and we wonder when the term of the lease expires. Now, often that number is cross-referenced in the notes to the lease commitment note, but here it's hidden in that if you look at page 8, note 1C, that's the note where it tells you over what rate they're writing off the leasehold improvements, and they've snuck in there the fact that the term of the lease expires in 1984. So then you jump up and down and say, well, if the lease expires, I want to know what the rent's going to be and what kind of terms I can get, and if I'm looking at moving, what the moving costs are going to be and what the disruption to business is going to be, and those are all questions that pop up. While we find in the supplementary information in the case that the rent would be $15,000 a year and they would get a 10-year lease. So that's not so bad. It's not going to seriously upset this company, although it is a large increase. So we turn back to our income statement again to continue our analysis. On page 6, we see that bad debts are at $6,500 this year and $5,250 this year. So that's not, if we compare them to sales, we take them as a percentage of sales, you're at 0.87% this year and 0.86% last year. So the percentage is fine, but we're still concerned about that average number of days sales in receivables of 60 as compared to 40 last year. And I'm still concerned about the quality of the receivables, and maybe more bad debts should be written off. So you still have that concern even though the percentages are comparable. Okay, we look down to income taxes, and we do a quick calculation of the rate. You see the rate this year is 23.7%, and last year it's 24.5%. So that just tells us that the company's getting the low tax rate. The Ontario tax holiday reduction of 10 percentage points has not been included in the case. Okay, now we take an overview of the income statement, and we calculate our gross margin. which the gross profit, you see for 1983, a quarter of the way down, is $251,000. We divide that by our sales of 748, and we get 33.5. Last year, our margin was 32.8. So we're delighted to see that because sales have increased 22%, and a lot of times what you see is that the margin gets slashed to increase the sales, and the profitability isn't there. In this case, they've been able to increase their margin and slightly, so they haven't. It doesn't appear that they have been slashing price to get sales. So we're happy at that. That's a very positive point. We have to be careful of large, non-recurring orders being in our sales that have decent margins. So you'd want to ask a question like that: is there anything big that's unusual that's distorting these margins? We look down to our total general and administrative expenses, about halfway down the page. They are at 87 this year. They're at 78 last year. They've increased 11.6%. So with the volume, we've assumed an 8% inflation rate, and with the additional volume, that doesn't look too much out of line overall. Now we look at our income statistics as a percentage of sales. Our pre-tax operating income, if you look down 3/4 of the way, where it says operating income, you see 57. We take that as a percentage of sales. That's 7.6 as compared to 8% last year. So they seem to have been fairly well to have maintained their percentage. So that's positive. If we look at the percentage of sales based on after-tax income, the total bottom line, the net income after everything in, then it's consistent at 6%. So it doesn't appear that the volume has distorted the percentages at all. They seem to be getting the same return. So what is this business making the shareholders? So we look at what the return on book debt is, which means we take our income for the year and we divide it by our equity. And we took the equity at the beginning of the year because that's what we started with, and the income occurred during the year. So we don't use ending retained earnings because we didn't have all the profits until the end of the year. You could argue that you should use an average there, but we've taken it so you can see the numbers fall at the beginning of the year. So if you take the 45 in a very simplistic way and divide it by the 150 in opening equity, you'll see that they've got on book equity a 30% return, and last year a 32.7 return, which is excellent. Now we said before that you should adjust for fair values, and this adjustment is done in Bill's section for the increment in fair values when we get into the valuations. I just kept it simple here so you have a better chance of following. Now this analysis is only valid if the salaries to A and to B, the owners, are reasonable salaries for the services performed. If they're lower or higher than what's reasonable for that type of work that they're doing, then that number, the income number, should be adjusted for that. So if they're taking the remuneration through dividends and they're not taking anything out, then you need to adjust for that on what we have here is the 45 to get a good. So what do we conclude? What do we conclude about this company? Well, we've got a lot of questions. We'd like a lot more information. But from what we can see, we'd say the company is in a very satisfactory financial condition, that it seems that it would be in if it went to borrow additional funds, that it shouldn't have a terrible time, providing that the funds were for a reasonable purpose and required. It has an acceptable working capital position, so it would seem to be in a fine position to meet its commitments as it comes due over the course of the next 12 months. Company sales growth has been very substantial. And management at the same time has improved margins and controlled inventory. We're still concerned about that receivable, but they have improved their margins, and they've maintained control over inventory. And that's something which, in a high-growth situation, is in an owner-managed business, is typically highly unusual. Normally, you'll see some of the numbers somewhere getting out of whack. Their inventory will run high, their margins will run low, and it's very usual for them to have less overall profit at the end of the year with sales increases like that. So, and the shareholders on their investment seem to be getting a very acceptable rate of return. Now, the ratio, some of the, and I haven't put them in here, some of the comparisons where I'm using for this type of business, I've used out of the Dun & Bradstreet 1983 key business ratios. That's where I've got some of them, and other ones are just from my own experience. So if you are doing this type of analysis, that type of information is useful to get. Stats Canada also has information on operating information on companies, and that's often very useful as well. But I haven't put that information in because it would just complicate it. But when I say that these are acceptable ranges, that's where I'm getting the information from. Okay, now we have some time for questions. If anybody has any questions, I'd like to. Yeah. The question is for items in inventory which have commitments against them, or for which a supplier has taken that item back as security against their own receivable. This gentleman has never seen that documented or disclosed in the notes to financial statements. And any commitment like that, financial commitment, or any asset given as security, if it's material, of course, if it's significant. If it's not significant, it likely won't be disclosed. But any commitment like that under generally accepted accounting principles should be disclosed. And that really is no different than the receivables and the inventory being given as security to the bank and the equipment to the FBDB, as that's noted. It would follow the same type of disclosure. Sometimes you do see it broken out separately.
Where would it appear on the statement?
Pardon me?
Where would it appear on the statement?
Oh, you would have inventory in brackets. Do you see on page 5? Under the inventory, it says Note 2. You could say Note 2 in brackets there. You'd say Note 2 and Note 6. And Note 2 would stay the way it is, but Note 6 would say that there is $50,000 of inventory which has been pledged as security to a supplier's payable. Any other question? Mm-hmm.
Is there any way if the statements are prepared without an audit that someone reading the statements can check them for integrity and make sure they make sense?
For integrity, as far as do they hold together and do they?
Well, I guess I'm using the wrong word, but for accuracy.
So can someone check the statements for accuracy if they're unaudited? not short of doing an audit and doing things like counting inventory and pricing inventory and confirming receivables. There's nothing you can do there. You can do the ratio analysis, and you may find out a lot of things when your questions are answered from the ratio analysis that it just doesn't work, and that there should be receivables written down or inventories written down, and you can, when you do your analysis. But there's no way that you can really verify. If everything looks all right, then look.
Peter, you had a key point about analyzing gross margin. Certainly, a great audit tool or reading someone's statement is having the owner of the business explain the change in gross margin and segment it between the changes in price and changes in volume. It's certainly a
Right.
great audit technique on an income statement. What happened to your gross margin? The fellow's not very conversant on what happened and he did further.
Yeah. Yeah.
Could you repeat that, please?
Lou mentioned that in doing gross margin analysis and sales increases and that those types of calculations, that if you discuss those with the owner and you ask the owner what's going on in those cases, and if he's not very conversant in those situations, then you may suspect something is going on. But again, if he just doesn't know, a lot of times it's like he doesn't know, and he really doesn't, because his management information is so bad that he doesn't have a good handle on it. So you're kind of stuck in those situations where you're stuck with bad information. But that also tells you something about management. It tells you a lot about management, and that's important. Yes? What's that? No, I haven't. I haven't calculated all the ratios. Appendix C in your binder has a lot of ratios there that I haven't calculated, and we put that in for your future reference. I only calculated the ratios that I was concerned with this particular company, and I didn't get into capital employed heavily because there was, in the background information, there's a lot of fair value increments that you'd need to adjust, and the calculation would become, to do it properly, would become very complicated very quickly. So we've kind of kept it to simple types of ratio, and the most common types of ratios. But there are more that you may want to know, and you may want to utilization of fixed assets and that sort of thing you may want to get into. Any other questions? So in looking at inventory, would it be reasonable to have a note to the financial statements talking to seasonal fluctuations and possibly giving a cash flow?
Well, yeah, I'm wondering if it would be reasonable to do that, or simply to do a 3-month or a 9-month statement or whatever. How would you refer to
In the annual financial statements, you wouldn't disclose or talk to seasonal fluctuations. Normally, you would normally have cash flow and profitability projections for the next year, and that certainly would be in there. Those fluctuations would be in there. So that would be supplementary information that you'd have to ask for. Okay, is there another question? Yes?
In the case study on page 4, paragraph 16, there's a column headed depreciated replacement value. What's the difference between depreciated replacement value and replacement?
Okay, we're talking page 4, item 16. Depreciated replacement value. And what's the difference between that and...
Is that the same thing as replacement cost?
If you... All right, Bill's going to Bill's going to talk about those in a minute. But it's really the same as if you had to replace the asset in that state, which you likely never would, but right, like leaseholds, if you had to replace it with a year left, what would it be cost you to replace it? So that's, okay? Sorry, I can't hear you. In the balance sheet, page 5, fixed assets. Yes. Oh, yeah. The question is where it says on page 5, fixed assets, less accumulated depreciation and amortization. Which type of assets would you amortize rather than depreciate? The amortization refers to the leasehold improvement. And they call it the amortization, I guess, because it's pretty tough to remove the leasehold once it's in, so you spread it over a number of years, whereas the fixed asset is easier to remove.
These statements assume the audited.
Pardon?
These statements assume the audited.
We're not told that. We don't have any reports, and they're not marked.
What value would they have if they weren't audited?
What value would they have? You could still do the same analysis on them, and there could be absolutely no difference between audited and unaudited financial statements. It's just credibility. If it's audited, then a chartered accountant has signed his name to them, attesting that they fairly represent the financial position of the business and the statement of income and that sort of thing. But on unaudited statements, it just hasn't had that attestation.
It's being prepared entirely by the company. Is that what unaudited means?
No, it could be prepared by a CA, but he hasn't applied all of the auditing techniques, or he hasn't applied auditing techniques to the financial statement. So he hasn't, because the business didn't want to pay the extra money or didn't require it, he hasn't sent letters to all the accounts receivables confirming that they actually owe the money, and he hasn't sent letters to the payables, and he hasn't counted the inventory. But management has done that, and management has priced it. And so the accountant has reviewed it and prepared the information.
Would anybody ever buy a business on the basis of unaudited statements?
Oh, yeah, sure. In the very small businesses, you don't, none of them, well, not none, but it's rare to see audited in very small businesses.
Audited statement, does he actually have his own representative go do the inventory and report these directions?
When a CA audits statements, does he actually have his own representative from the CA firm go out and examine the inventory?
How does he know that
He would attend, management would count the inventory. They'd have procedures. The CA would review in advance with management their planned procedures, and they're normally in writing. And staff would go out to count the inventory and take tags down and document after management has counted, and to review the count to make sure that it has been counted properly. And then they would also price it and agree it to, on a test basis, agree it to after management has done it. So the company does it, and then the CA firm checks it.
What is your experience with returns to those letters that come out to lawyers for disclosure of matters?
What is our experience?
Yeah, do they show up very much that's not explained to you by management?
I don't understand your. You mean do we get the lawyer's letter back?
Yes, you get it back, sure, but do you find any discrepancies between that letter and what management is told?
No. In the lawyer, the question is, do we find, in an audit situation, do we find many discrepancies between what management has represented to us and to what the lawyer says? And no, that would be rare. If there's a problem, we normally know about it, and we normally have resolved it in advance of the written word. I would say that's rare. Anything else? Yes?
If you're looking at the return on equity, the natural return, not very sure. Why would we do the return on the equity place at the beginning of the year rather than the end?
Okay, if we're looking at what the return on the equity is, why would we use the balance at the beginning of the year rather than at the end of the year? Oh, rather than average, because the profits are building up and theoretically they get, every day they get recycled. No, that's right. That's a good point, that if you want to calculate this exactly in theoretical terms, then you should be taking an average of the retained earnings. And I mean, you could get as sophisticated as to look at monthly income and build it up that way. But this calculation on page 48 isn't a very sophisticated calculation, because we also haven't gone through the gyrations of adjusting for the fair value differences. And that's why it's just noted there that we haven't. Any other questions? Okay, now we're going to have Bill take over on valuations.